How to stay calm during market volatility. Hey everyone, welcome back to Finance Clarity. Let me ask you something honest. How do you feel when you see the stock market dropping sharply? Maybe 5%, 10%, or even 20% in a short period of time? If you're like most people, you probably feel some level of anxiety, stress, or even panic. Your first instinct might be to check your portfolio constantly, read every news headline, or worst of all, sell your investments to stop the bleeding. Here's the hard truth. Market volatility is completely normal, but our emotional reaction to it often does more damage than the market drop itself. Many investors make their biggest mistakes not during calm markets, but during periods of high volatility. They sell at the bottom out of fear, only to watch prices recover shortly after. Or they become so scared that they stop investing altogether and miss out on long-term growth. The ability to stay calm during market volatility is one of the most important skills an investor can develop. It's not about being emotionless. It's about managing your emotions so they don't control your decisions. In this video, I'm going to show you exactly how to stay calm during market volatility. I'll explain why volatility feels so scary and give you practical techniques and mindset shifts to help you handle it better. If you want to become a more resilient and successful long-term investor, stick around. This might be exactly what you need to hear. Let's get into it. Why market volatility feels so scary. Market volatility refers to periods when stock prices move up and down sharply and unpredictably. These periods can last days, weeks, months, or even longer. There are several reasons why volatility triggers such strong emotional reactions. 1. Loss aversion. Humans feel the pain of losing money much more intensely than the pleasure of gaining the same amount. When your portfolio drops, it can feel physically and emotionally painful. 2. Uncertainty and lack of control. Volatility creates uncertainty. We don't know how bad things will get or how long it will last. This lack of control triggers anxiety. 3. Media amplification. Financial media and social media tend to dramatize market movements. Constant negative headlines can make volatility feel much worse than it actually is. 4. Recency bias. When markets are falling, it's easy to believe they will keep falling forever. Our brains give too much weight to recent events. 5. Fear of regret. Many people are more afraid of making a mistake, like holding through a crash, than they are of missing out on potential gains. These psychological factors combine to make volatility feel much more threatening than it often is in reality. Why staying calm during volatility matters. Staying calm during market volatility is not just about feeling better emotionally. It has real financial consequences. When investors panic and sell during downturns, they often lock in losses, miss out on the recovery that usually follows, disrupt their long-term investment plan, create a cycle of buying high and selling low. On the other hand, investors who stay calm and continue following their plan tend to benefit from market recoveries. Take advantage of buying opportunities during downturns, build more wealth over the long term, experience less stress and anxiety about their finances. In short, your ability to stay calm during difficult markets can have a massive impact on your long-term investment results. Common emotional reactions. During market volatility, here are some of the most common ways people react emotionally during volatile markets. 1. Panic and fear. The urge to sell everything to avoid further losses. This is one of the most damaging reactions. 2. Overconfidence during bull markets. When markets are rising strongly, some people become overconfident and take on too much risk. 3. paralysis and avoidance. Some people become so overwhelmed that they stop checking their portfolio or stop investing altogether. 4. FOMO reversal. After a crash, some people become afraid to invest again, missing out on recovery opportunities. 5. Constant monitoring. Checking your portfolio multiple times a day, which increases anxiety and often leads to impulsive decisions. Recognizing these patterns in yourself is the first step toward managing them better. Practical techniques to stay calm. During market volatility, here are some effective strategies you can use. 1. Have a written investment plan. Before volatility hits, create a clear plan that includes your goals, time horizon, and what you will do during market downturns. When emotions run high, refer back to this plan instead of making decisions in the moment. 2. Reduce how often you check your portfolio. The more frequently you check your investments during volatile periods, the more anxious you're likely to feel. Try limiting yourself to checking once a week or once a month. 3. Focus on what you can control. You can't control market movements, but you can control how much you save. Your investment costs, your behavior and decisions, your time horizon. Focusing on these things reduces feelings of helplessness. 4. Use dollar cost averaging. Continue investing smaller amounts regularly, even during downturns. This removes the emotional decision of when to invest and helps you buy more shares when prices are lower. 5. Limit your exposure to financial news. During volatile periods, the news is often overwhelmingly negative. Reducing your consumption of financial media can help lower anxiety. 6. Talk to someone objective. Discussing your feelings with a trusted friend, family member, or financial advisor can help you gain perspective and avoid making emotional decisions. 7. Practice perspective taking. Remind yourself that market downturns have happened many times before, and markets have always recovered over the long term. Look at long-term charts instead of daily movements. 8. Take a break from decision-making. If you're feeling highly emotional, give yourself a cooling-off period, at least 24-48 hours, before making any investment decisions. Mindset shifts that help during volatile markets. Here are some important mental shifts that can help you stay calmer. 1. Accept that volatility is normal. Markets are supposed to go up and down. Volatility is not a sign that something is broken. It's a normal part of investing. 2. Think in decades, not days. Train yourself to think about your investments over a long time horizon. Short-term movements become much less important when you zoom out. 3. Separate your portfolio from your self-worth. Your investment performance does not define you as a person. Detaching your emotions from your portfolio value can reduce stress significantly. 4. View downturns as temporary. Market declines are almost always temporary, even though they don't feel that way in the moment. History shows that markets recover over time. 5. Focus on progress, not perfection. You don't need to make perfect decisions during every market cycle. Consistent, good enough behavior over time is what builds wealth. Systems and habits that support calm investing. Building systems can help reduce emotional decision-making. Automate your investments so you don't have to decide when to buy. Set rules for yourself in advance. For example, I will not sell unless my investment thesis has fundamentally changed. Create a simple rebalancing schedule instead of making changes based on emotions. Keep a journal of your investment decisions and the reasoning behind them. Review your long-term financial plan regularly, not just during market volatility. These systems create structure that helps you stay disciplined even when emotions are running high. Real examples of staying calm versus panicking. Consider these two common scenarios. Investor. A sees the market drop 25%. They panic, sell most of their investments at a loss, and move everything to cash. When the market recovers over the next 12 to 18 months, they miss out on significant gains and feel regret. Investor B sees the same 25% drop. They feel uncomfortable, but they have a plan. They continue their regular investments, maybe even buy a bit more during the dip, and stay invested. Over the long term, they benefit from the recovery and compound growth. The difference between these two investors is not intelligence or luck, it's mindset and behavior during difficult times. Final thoughts. Market volatility is an inevitable part of investing. You cannot avoid it, but you can learn to handle it better. Staying calm during volatile periods is not about being fearless. It's about recognizing your emotions, understanding that they are normal, and making decisions based on your long-term plan rather than short-term feelings. The investors who build real wealth over decades are usually not the ones who avoid all volatility. They're the ones who have developed the mental strength to stay disciplined through good times and bad. If you can master this skill, you'll already be ahead of most investors. Not because you're smarter, but because you're better at managing yourself. Thanks for watching. If this video helped you understand how to stay calmer during market volatility, please like and subscribe for more practical investing content. Drop a comment below and let me know how you usually feel when markets are volatile. I read every comment. I'll see you in the next video. Take care.